Right, so advanced chart analysis. So we pull up this particular stock, Apple. Right, we go. So the first thing you want to do when you want to, you want to do your chart analysis for a stock for the first time, you want to go to a big time frame. So we only 5-year time frame. Right, and the first thing you want to do is identify and draw your trend lines. So your trend line, you would have your bottom trend line and your top trend line. So you go here, right, trend line, and you draw a trend line from where this bottom part of the stick, this candlestick, right, touch here, and you're drawing it to where it continues to touch. Right, this is a trend line for over the past 5 years. As the saying goes, the trend is your friend. Trend lines are very important. It's the first, it's the most fundamental aspect of chart analysis. Is the overarching indicator, I would say, or confirmation. The trend line is very important. It's the first thing you do. Right? You have a nice little trend line going here. Right? So what the trend line does, folks, it indicates to us basically the lowest that the market could go or the highest that it go because of the history. Alright, because of the history, it's a kind of a predictor as to the highest or lowest point that this particular market would go. Right, and as we see, when it touches the top, it falls, as we see here as well. Alright, touches the bottom, it rises. So the first thing you do is you draw the trend line. And the second indicator I would use, now you have a volume down here, but the second indicator I would use is, what's a sec? Second indicator I would enter is the RSI indicator, the relative strength index. Very important. Very important indicator, folks. Alright, so now some quick jargon to note. Bullish, bearish. Bull market, bear market. So bull market means there's an upward trend, right? Upward trend. Once the price is moving upward, you're bullish. You're in a bull market. Once the price is moving downward, bear market. Why? Just Google it, you will see the pictures of just search bullish trend, bearish trend. It will show you how the animals look. A bull tend to stand very, its posture is very upright, and the bear, the posture of the bear, the head down and whatnot. So that is why they choose those animals to represent the cycles that the market would go through: bullish and bearish. Right, so we have the RSI here, and I want you to take a look at the RSI and compare the levels of RSI to that of the chart. Alright, so let's look at 2021 and the brink. See that little dip. You see it's consistent with the market. Key points to note: when the purple line is above the yellow line, you're bullish. When it's below, you're bearish. Right? Pay very close attention and compare with the chart, and you would see that what I'm saying is it is consistent. The RSI is consistent with the chart. The RSI is one of my favorite, one of the best indicators, one of the absolute best indicators. I call the RSI God in the market. Alright, RSI is king. MACD is king. We'll get to the MACD later on, but pay attention to where I'm at right now, Monday the 1st November 2021. So you see that the purple line was below, it converged here, diverged, and if I'm doing a long trade, here is a good spot to enter. Good spot to enter. Once the volume is also good, I would enter here into if it's option, I would call it it would be a call option. If it's just a buy and sell, I would enter here. Buy, that would be 151. $151. You go up. Alright, you go up, boom. You see where it peak at the RSI, then it begins to fall. It falls below, and boom, falls below. Now you're looking at a type of bearish type of something. Alright, it rises. So you see this purple line is very consistent with how the chart goes, or how the candlesticks, the movement of the candlesticks on the chart. Right? If I didn't say before, the candlesticks are, this is a candlestick, these are candlesticks. Alright, you'll also get to that. Alright, so point to note again. Now, when you're doing trades, you wouldn't really look at the 5-year chart. You would get closer in. Right? I just had it at the 5-year chart just to draw the trend line. You always want to zoom out to draw your trend line, your first initial trend line, that is. But you could also draw smaller trend lines, because things like these happen, right? For the mini patterns that take place, intra-month, intraday, you also tend to draw trend lines, small trend lines for these as well. For example, right here, BAP, BAP. A little trend line going there. Right? So we know that once you break the trend line, then the market is heading somewhere else. Alright, but if it comes down here, bounces again, and that kind of thing, so we have a trend line going here. Alright, again, look at the RSI. Very consistent with the chart. Now later on we'll get into where something like this happens. The RSI crosses over. When the purple crosses over the yellow, purple crosses over, where was I? Purple crosses over the yellow. So let's say we're looking at this piece of action here, and we see something like this. Alright, boom. You see how the purple crosses over here. Alright, so that's an indicator that the price is going up. Alright, you're going on a bullish run, as you can see. So price was initially 227.60. Alright, so it goes up and continues to rise tremendously. 241.49. Now, if you're using an indicator, well, this particular indicator for, you know, entry point and your exit point, because we're dealing with buying at the low and selling at the high price. I mean, that is common sense. All right, if we're in the market and we suppose we're doing retail market, wherever the case, we go by the wholesale person and we get oranges, let me say potato, we get potato for $1 a pound, right? Let's just say you buy 50 pounds of potato, right, at the dollar. You want to sell it at a higher price to make profit, obviously, right? So you sell at, well, what have you, $2, $3. The higher you sell it at, obviously the more profit you make, right? So here is the same concept. You buy low, you sell high. All right, now with options trading is a bit more complicated, but we're dealing with options trading. We're dealing with traditional trading, buy and sell, the fundamentals of trading. All right, you buy low, sell high. So again, you want your entry point to be where that purple line crosses over the yellow. You're looking at the RSI here. Boom. 227.60 thing, it goes over, back. It continues to rise, but where do I exit? Well, you're right. Where the purple line crosses back under the yellow line. That is the exit point. Alright? 243.44, you exit. Now, let's just say I don't exit. Let's just say I disregard the RSI, and the RSI is king. Let's say I disregard the RSI completely and I just leave this thing to run. Alright? What happens to me? Let's see. Well, I get a little lucky here. 247, it continues to go up, and then what happens? Crashes. Alright? So you don't want to play greedy and leave it to run, because look what happened here now. You're going back down to 240, where you could have exit here, right, at 246. Right? So you want to exit as soon as this crosses over. We didn't really cross over here, but the safest thing, when it converges, you want to exit. You want to exit that trade. Alright, so I think I have the RSI covered. I think we understand the RSI. Alright, now for options trading sake, because with options trading you can make money when the market is going down as well, right, with put options. So as we see here, we just carry it back. As we see here, on the purple line on top, you see it converging, boom, it falls from 236, it falls to 226. Alright, with option trading you can make money. So it's an indicator as to where the market is going. Very important. Right. So for teaching purposes, I'm going to take off the RSI, and I'm going to cut on the MACD indicator. Moving average, convergence, divergence. Right. Again, my favorite one, well, along with the RSI, my favorite. This one, it shows a bit more detail, this particular indicator. Alright, it shows a bit more detail, and I'll show you what I mean here. Let me zoom in a bit into the 1 month market. So nice. Let's look at here. Monday or Tuesday, the 11th of February. You see how this blue line, well, it was at a lot here, and then it just separates, it diverges from the orange line, and you see this semicircle of dark green and then a light green sort of bars. Alright folks, this is what I call a cycle. This is now my terminology. I choose to call it a cycle, because throughout the market you would get these bullish cycles, then you would get a bearish cycle. Alright, you have a bullish cycle all of the way here, and then you have a bearish cycle. Right? So it shows you again when to enter. Say enter where the blue line separates from that orange line, and you see this semicircle, this bullish semicircle with green bars taking place, right? And you would exit really and truly really and truly the exit point should be where the blue line meets the orange line, or the blue line crosses over and goes underneath the orange line. However, from an advanced trading perspective, pay attention as soon as you see the dark green turn to light green. Really and truly, it means the buyers begins to slow down, and the sellers are starting to take control of the market. So as you see, dark green bars, as soon as it turn light green, you see candlesticks begin to go red, and the price begins to decrease. Alright, now it's up to you, up to your discretion, if you want to stay in the trade, right? Because I mean, if you buy at here 228, boom, it goes up, bam bam bam, you stay in the trade, you're risking, you think it still have potential, because I mean, you know, the blue line didn't really cross over, it's still kind of on top of the orange line, and then you see boom, goes again. You know, so you stay in the trade and you make a little more profit. I mean, that is a risk, but definitely if you stay in the trade and you see this taking place, you see another divergence here, and you see, you know, some more bullish indicators right here, bullish indicators, right, small bullish cycles. You stay in the trade, and I mean, you make a fortune, really and truly, right? But of course, this in hindsight. Now when the market is live, when the market is live, you'll be looking at it like this. Should I exit? Should I exit? You know, I'm seeing this slowing down, you know, I'm starting to pay attention. Most people would exit. I would exit, really and truly. Alright, but if you choose to stay in, you see, the fortune just, you know, it works in your favor. Alright, not all the time that happens, folks. The market is a very ruthless place. Right, so right, with the MACD again. Alright, so bullish, we bullish, crosses over here. Alright, crossover, you see boom, massive dip from 238 to down here 234. Alright, I believe we get in the picture. Alright, this is you see a bullish cycle, a bearish cycle, a bearish cycle. Alright, now another thing to pay attention to, so you see the blue and orange line above the middle line. The middle line is right here. The middle line, it's the middle line. So in this period here, it's above the middle line, you know, which kind of indicates that, you know, the market is a bit bullish. All right, so I mean, definitely if you see a convergent divergence here, the blue line separates and you're above the middle line, folks, you take that trade, you're buying, because you know that stock price going up, sure. Right, now same thing on the negative side. If you see it goes below that middle line, you see that blue line sharply goes below that orange line, you show you in a bear market, as you can see here. Now even though it went below, pay attention now, even though it went below here, the blue went below the orange here, the bearish intensity is not so strong, right? It's not so strong until it, you know, it goes below that, you know, you're in strong bearish territory. The market, the price is going down. All right, so bullish cycle, bearish cycles, as we can see. All right, now this is what I think I was only 1 month. Now when I'm trading, and we will talk about this in future videos and probably later on in this video, but when I'm trading, I look at the 1-day chart, because it's most accurate, it's less risky. All right, when you look at the 1-day chart, you would see. Now when you look at the 1-day chart now and you follow your indicators, you wouldn't get much volatility or movement. I mean, this from here 233, the 235 is only $2, but I mean that $2, you know, when you're dealing with options and whatnot, that $2 could be hundreds of dollars, thousands of dollars, depending on how much money you're working with. All right, but with options, in fact, I use the 5-day chart. Alright, and what I tend to observe is that you would have about 1, 2 or 3 cycles throughout the course of the day. Alright, so for example, you're looking at the 5th, Wednesday the 5th of March, definite bearish cycle here, right, where you saw stock drop from 238 to 231. That is actually a very sharp drop. A lot of money to be made there in options trading. Alright, and the other cycle would have been right here. Again, you're looking at the MACD, blue line going up, going over the orange line right here. Boom, from 230 to 235. When I say that, I mean I would exit around here. Right? 234, 235. Alright, so you get about 2 major cycles where you can really, you know, make money throughout the course of the day. You're looking at the 5-day chart for options trading. Alright, so leave that with copper MACD. And folks, I really want you all to follow as we go along. You know, you can go on your laptop and you can just pull up tradingview.com. Alright, you go to the charts, and you know you pull up a stock, you know, right here. Alright, pull up same Apple. And you can do this yourself. You could just go in indicators, you choose your MACD. You could just search the indicator here, MACD. Alright, moving average, conversions, diversions. Right, RSI, right, relative strength index. Put on your RSI. Alright, so I'm going to show you all now what I usually, my setup. I use the MACD and the RSI at the same time. I also use fractals. I mean, fractals isn't that important, but you know, I still use it, you know. Alright, and with fractals now, you want to edit, you want to, so you see these little arrows, you want to go on your fractals now, and you want to edit, and you want to change the input to periods of 9. Alright, so fractals basically will tell you, so when you see the green up arrow, it means that it's going down. You reach the end of the bullish cycle and it's going down. Red, it's going down. Alright, that is fractals for you. Fractals is just an additional indicator. It's not something you would look, you know, you're looking at the fractals to see if to make a trade. You don't make trades based on, you know, fractals alone. Right? You already identify who running the show. The RSI and the MACD. Right? And your volume here, very important as well. Right? So this is typically my type of setup. There's one thing that is missing. Let's create some space here. Let's have to create some space here. Alright, so last but not least, you would have your support and resistance lines. So support lines would be where so you see here this particular, right, so boom, you went down and you bounced from there, went up, you reach there, bounce up again. That is a support line. So what I would do, I would draw a horizontal line here, right here, right, a green horizontal line, because that is a key area of support. Meaning, if the stock reaching to that level, there's a chance it could bounce up from there, basically. Alright, there's also resistance lines, which is basically the opposite. So we see here is right, so 1, 2, 3. Alright, you know here is definitely an area of resistance. Alright, let's think about the good resistance. Alright, so any stock reaches that particular point, it tends to resist or reject from that level, and it drops. Alright, now in real and practical terms, it's because sellers, those hedge fund traders, put their Yeah, so those hedge fund traders tend to put their stop loss right around this particular, around these prices of resistance, around these prices. So that's why there's potential if this stock reaches to that point, it could resist and drop down, because men put the stop loss and they would sell off, or they take profit. They take profit, in fact, and they would sell off, right? So because they would buy at a point and put the selling point, they set that selling price as whatever, and of course when they sell, the price goes down. So that is where resistance comes from. Alright, support, I mean, basically the opposite. Support, persons put their buying orders around here, put their buying orders around that price. So you tend to see when the stock reaches to that level, it goes up. There's a lot of persons, or hedge funds, really and truly retail traders like myself, who trade with small money, hundreds, thousands, even hundreds of thousands, don't really affect the market. Hedge funds, persons who trade with tens of millions and hundreds of millions and even billions, is they who really affect the market and affect the charts. The small thousands that we trade with, it doesn't really have an effect on the movement of the chart, right? Tens of millions, billions, and so on. That's what really moves the market. Alright, we just profiting off basically how the hedge funds trade. Basically, I mean, retail traders make up a lot of the market collectively, but me as an individual, me trading, really and truly, let me say, I sell $20,000 in shares. That wouldn't cause the market to jump. It wouldn't have an effect on the market, really and truly. Alright? The big money boys, they make the market, not thousands and no. Alright? So you wanna put your support and resistance line. Alright, where you see, period where it touch multiple times, right? Touch multiple times, there is support and resistance, right? So around here, yeah, support and resistance. So zoom out a bit, let's see what other support and resistance lines we can put in. Put one around here, definitely a support line, right? Because we see, right, so support we do green because it bounces and goes up, right? Resistance is red because it rejects. The only terminology, right? Pay very close attention to these videos and what I see, the jargon and whatnot, because I'm unpacking hundreds of hours of studying this thing in these short videos. So absorb everything that I say, right? Everything that I say is basically, you can put it into practice and profit and make money and get rich off of it, basically, right? I use the jargon, right? I've been trading for a while. These is the things we do, right? These is the words we use, and this here is a very good support line. So let's just say, for example, tomorrow, please God, which is Friday, the stock goes down to boom, and well, there's a chance it can bounce here on the green, or if it goes below the green, we know the next point would be here. Right? So important to note. Right, so let's say tomorrow it drops because, I mean, when you look at the indicators as you the viewer now, who's at a very good level, if you paid attention to this video, you see that, you know, the RSI, the purple, goes below, and you see a bullish a bearish cycle starting here. You know that, yeah, this market kind of it going down, price is going down. There's a high chance the price could go down, and let's say it goes down to this support line here. There's a chance that it can bounce up. That is what the support and resistance line is for. That's what they tell you. Alright, now if it goes through that support line, right, you can enter a put option, which is basically betting that the stock price is going down. We'll get into stock options in later videos, but yeah, because we know that with all this room here, there's a high chance that the next time that the stock price is going to go up is when it hits this point of support. All right, so from here, let's say it goes down, it completely, you know, bypasses that line. Then make sure it completely bypasses the line. 225, boom, I get in that put option. It continues to go down, and I would look to exit around here because there's a chance it could bounce from here. Now if it goes down below that, then, you know, we want to continue drawing some lines so we could have some assistance with your support and resistance. Another line here, you know, I would draw a line here. You know, I would draw a line here because, you know, it touch here, right, and it touch here, back up. So I would draw a line there. Alright, I may not draw a line here. Because, you know, it only touch once. Right, so but definitely, you see, you all understand what is taking place here. Alright, you have your RSI indicator, your MACD indicator, your volume, which is also very important, folks. Very, very important. Very, very important. Alright, the green bars obviously for buyers, bullish, right, and your red is for sell. Right, that volume, that is the trading volume in terms of buyers and sellers. Green for buyers, right, which indicates the market will go up, and red for sellers, indicating the market will decrease or is decreasing. Alright, you want to trade when there's high volume, not in lull periods, you know, where there's low volume, you know, and you see stuff like these. You wanna try to kind of stay away from, you know, things like these. I mean, I'm watching it on a big time frame, but when we actively trading and trying to make money, we look at the 5-day for options and the 1 day for, you know, penny stocks. Right, so cases like these here, around here, you don't trade, folks, because this is what we call a lull. And you look at the MACD indicator, you see that the blue and the orange is like these friends. You don't want to trade when this is taking place, because what that means is that the price is not moving. We could only make money if the price moving. So we want volatility. Alright, so like here, massive separation here, massive divergence. You see some good volume here, good green volume. You see the price goes up. You don't want to trade in a lull where these lines too close, right? Where these lines too close. You see, right? That is called a lull. You don't trade in a lull. Be wary of it, right? So that would conclude for now advanced chart analysis. Right? Yeah.